Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, or good evening, wherever in the world you are reaching us today on YouTube, Spotify, or wherever you listen to your podcast. Thank you for joining another episode of The Debt Doctor. My name is Bill Bymel, and we are here for another coffee with Bill this morning. I just got a resupply of my favorite shipment of Nespresso coffees this week. It is the third week of October 2025, and today's topic is a recap of the markets from my perspective on the heels of the annual ABS East Conference that took place earlier this week in Miami Beach, Florida at the Fontainebleau. This is a conference that I have been attending for, I would say 15 years, maybe more. ABS actually stands for asset-backed securities. There's a West version of this, which is actually done in Vegas every year, and that's in February. And these two, and the one in February in Vegas, for those of you that are students of history or watch movies, especially if you've listened to the podcast, you hear me talk about the great financial crisis. That's where my career of buying mortgages was born out of. And that conference is the famous conference where in the movie The Big Short, the character gets up and says, in front of all these bankers that the world is about to end. And so the reason that this conference is significant is asset-backed securitization is a lot of what fuels the private debt markets and liquidity within debt markets around the U.S. And the explosion of all types of new credit that maybe you all, think that they came from tech or that you didn't expect to see 10 years ago. All these new sophisticated ways of financing and using securitization or leverage, it's all debt, basically, is just different ways of juicing the system. It's also, in the case of mortgages, a reason why you can get a 30-year mortgage, that at under 10% interest, because liquidity in the secondary market, securitizations, it's what theoretically brings down the price of borrowing for consumers. Well, so perfect for those that aren't watching the video. I do these podcasts on video on YouTube. For those that are just listeners, I'm holding up my cup this week, which was given to me by my daughter a few years ago. It says MEH, M-E-H. I think that would be the term that I would describe for how I felt that conference, the general vibe of that conference. Now, I will tell you, it broke records. If you it was reported on. I was only there. I flew in red eye Sunday night, got to Florida Monday morning, sat through meetings all day Monday, dinner, meetings all day Tuesday, and out Tuesday night. So I literally had a hotel room for 3 nights that I stayed in for one. But it was a lot of work, and the on the Monday afternoon of the event, it had started on Sunday. Bloomberg was already reporting over 7,000 paid registrants, something like 7,200, which was over 1,000 more than the last record ever set for attendance at this event. So, wow, that's good news, right? That's really, really great news. The world of asset-backed securitizations are booming. Well, maybe there's also another side to that. For those followers of this show, you know that about 2 weeks ago, a week or two ago, I came out with a canary in the coal mine episode, and it was on the heels of the announcement of two major bankruptcies that totaled over $1 trillion of debt or something like that. It was like some crazy number. I'm sorry, maybe it was a little less than that, but two major bankruptcies. One was an auto lender called Tricolor, and the other, that was a subprime auto lender. And the second bankruptcy was a company called First Brands, which was a auto parts supply, $1 billion auto parts supply manufacturer and distributor, and both of them went belly up. In the case of both of these companies, there was appears to be a massive question as to whether or not there is fraud. You have both companies that were apparently taking out hundreds of millions, if not tens of millions, if certainly hundreds of millions of dollars in loans against what they were offering as collateral to the lenders. That could be collateral in the form of titles to vehicles, or the lien on the titles to vehicles, because that's what subprime auto lender is maybe fronting the cash for someone who doesn't have a credit score to buy a car, who just buy now pay. So these are higher interest loans. And so the lien on the title to the car, that was supposed to be maybe there was the collateralization of income payments. You can also securitize that and collateralize that in order to get more favorable or even approval to get a loan or a securitization. Well, it turns out that not only are multiple private equity companies, lenders coming out of the woodwork now that these two have filed bankruptcy, in tens of millions, hundreds of millions of dollars in debt, but we're also seeing that several major banks, Fifth Third Bank, Chase, major players in the PE market, they had $100 million, $200 million lines of credit out to these companies, and are finding out that there was either fraud or mismanagement or a little bit of both or negligence, but there's double pledging going on. There's 30,000 missing cars that are due for repossession in the case of Tricolor. And seeing this, I said this is a canary in the coal mine kind of situation. And boy, I must say, I think I'm right. Of the 7,000 attendees at this conference, the ABSE's conference earlier this week, I didn't talk to more than a few hundred, maybe 100, 150. But the majority of them said something about Tricolor or First Brands. These are guys that aren't even in the auto lending business. It's ironic. One of my partners actually is now talking about getting in the subprime auto lending business, which I found fascinating. But if you think about it, this event is really starting to shake and rattle the investor class, and I think it's having an impact. It's more that it's probably going to wake us up to the reality that there's a lot more first brands and tricolors out there, and the proof came again this week. If you were following the last week's news of debt defaults in America, you should Google the name Cantor Group. Cantor Group is a California-based real estate investor who it came out about a week ago that one of their banks, Zion's Bank, was foreclosing on a $70 million loan that they had to this group, Cantor Group. Well, apparently that was the first string in a pretty large sheet to be pulled. And now about a week later, it turns out that the Stupins family, who is the gentleman who's behind the Cantor Group, Andrew Stupin, is now fending off multiple lawsuits and claims of debt default. So what started as one bank, Zion's Bank, having to write down a $70 million loan has now, including Western Alliance and several other lenders have come forward just in the last 2 days. The total amount of the loans that this group looks like they may have double pledged or did some kind of fraudulent thing with is $270 million. So, it has to be, in my opinion, that we are at that Bernie Madoff moment in the economy. It wasn't because a lot of people say that Bernie Madoff may have gotten away with his scam if it wasn't for the great financial crisis, which caused people to start pulling their money. I think we're hitting that point right now, just like I predicted this first brands and tricolor this would be the canary in the coal mine and would not go away. It seems like there is a snowball starting. You're hearing more and more concern. And we've been hearing this, by the way, the writing has been there in the shadows for some time. The media just chooses not to fully pay attention to it. And, why would anyone who is making money in the stock market want to believe that we are living in a bubble? Of course, but the reality is the warning signs have been out there. If you look at good publications, the private credit market was starting to show some concerns over a year ago. I was looking back at an article from 18 months ago in February of 2024. And it was a article in Bloomberg, and it was about flawed valuations threatening a $1.7 trillion private credit. And I think and this is something I've been speaking to in previous Debt Doctor episodes all this year. We are in this place in the economy where there's overinflated asset values in multiple asset classes, and no one really wants to sell anything because there's a pricing discovery that goes on, and a lot of the valuations that hold up the return profiles of private equity funds or any of these companies, a lot of those valuations might be based on 2022 numbers still, or 2023 numbers, especially when it comes to markets like commercial real estate, where it's simply a numbers game. Multifamily housing that was pricing to a 4 cap 5 years ago never really made sense to me. But now that stuff is repriced to normal 7 cap for A grade stuff, 9 cap for B, in the double digits for C and D. Now that multifamily cap rates have come back to a normalized level, there's anybody that was valuing multifamily 3 years ago is way overvalued. So, and then we are obviously from the world of residential real estate where I sit. I manage a fund that buys mortgages and real estate, single family homes and commercial. Um, I will tell you, since this summer, we've seen over 60% of counties on a nationwide basis seeing either a flattening off or an actual decline in values and a decline in selling prices as inventories are starting to spike. We're seeing it very definitively in places like Florida or Austin, Texas. We've even seen Salt Lake City and, other areas that became boom, other areas of the Southeast where the jobs just aren't there. I was listening to somebody point out the fact that in Colorado, it's one of the fastest growing populations in America, and yet there's been zero job growth in Colorado for 5 years. So there's a lot of factors at play here that haven't yet been realized in terms of the valuation of assets. And since the debt on assets, any kind of securitization, any kind of CLO, any kind of leverage or loan, all of that is value based as well. It's based on the yield you get, but also the credit quality of the loans, where they sit on an LTV ratio to the asset classes. You could continue to see more of a of a come to Jesus in terms of actual values. And I think when you combine these ongoing bankruptcies, bigger and bigger, more often each week, and then you add in that most of these bankruptcies are not a lot of these early ones that we're seeing here at this turn of the credit cycle are the guys that were fraudsters to begin with. I mean, it's gotta be a blinking yellow light. It is certainly a lot of what folks at ABS East were talking about. I was in rooms with major fund managers, with bankers, with vendors, with compliance people, with lawyers, with all of it. And it was an ongoing conversation about tightening, oversight, concern for what other cockroaches might be in the house, as Jamie Dimon put it this week. He says, when you see one cockroach, it usually means there's more. And by the way, there's folks in private credit that know what's going on here. There was a major private equity fund that was short the bonds of Tricolor. They knew what was going on. So, but what's scary about the private credit market, which I've always said, it's one of the reasons we're doing this podcast, is to try to create some level of accountability and transparency to private credit, because the reality is private credit doesn't really make a lot of sense to me. And I've seen some really interesting deals in the last couple of years. And that's probably the point that I really want to leave you with about ABS. ABS East, when I started going 15 years ago, ABS East was 80% mortgage-backed securities. And then 20% was, unique, more out-of-the-box stuff. Credit card securitizations make sense. Student loans even made sense years ago. Auto loans, securitizing, especially a paper auto, but then subprime autos. But there are securitizations for so many things now. There's CLOs that finance all different types of businesses. CLOs being collateralized loan obligations. And whereas 80% of the conversations used to be around mortgage, when I started going to this conversation, I was the minority by a big, big, big margin this year. And I'd venture to say it's exactly the opposite. 80% of the product out there, 80% of the deals that were being talked about were non-real estate backed lending, securitization, financed, collateral financed, whatever you factoring businesses. Here's my question to you. Is that real collateral? I mean, if you're lending on a pool of loans to automobiles, automobiles that could be driven anywhere. The word on Tricolor is 30,000 of their 90,000 delinquent loans, they believe, drove themselves over the southern border to never be seen again. If you're collateralizing a pastry, well, that's not a secure asset. That's, what happens if people stop buying products from this group? If you're collateralizing GPUs, I'm going to go off on another tangent here. If you're collateralizing computer equipment, well, the value of that stuff declines at significant rates. GPUs, which is what powers our computers, the NVIDIA chips that power all of our computers. They may cost anywhere from $500 to $2,000 a piece, but in a year from now, the one you bought, or 2 years from now, the one you bought for 2,000 today is going to be worth 300. So if somebody's lending against that at 60, 70 leverage and that loan stops paying, what are you going to go do? Take the GPU out of the customer's computer? And that is probably the message of today's coffee more than anything. We have not been living through any period of enforcement. We have not had a situation in this country in well over a decade where any significant number of defaulted borrowers on any scale actually had serious consequences as a result. We've lived in a world of declining interest rates since the GFC in 2008, where bankers and private equity guys like myself could get cheaper and cheaper money, where we could lower interest rates and help people to save their homes that way. Commercial bankers use those same lowered interest rates to help commercial real estate sponsors kick the can down the road and also increase values and leverage points to levels unforeseen before because of the confluence of the cap rates load, the low cost of capital, and a lot of demand from the cash that was spilled out into the U.S. government that we all had, post 2020. And with all that being said, we have not come up against any period of real enforcement. My favorite asset-backed security is the buy now, pay later loan. I mean, we know the major companies, there's some that are about to go public that are doing it. They all look like tech companies, but they're really Wall Street guys looking to bundle and securitize into more complicated product a series of loans that they value and that's in their interest to lessen as the issuers of these loans and the issuers of the securitizations of these loans. It's in their interest to make it seem like a less risky investment so that they can sell it to us as the end consumer investor, sell it to pension funds, sell it to other investment groups, and sell it at a lower interest rate, more spread for them. Buy now, pay later is not a securitized asset, in my opinion. If you stop paying on your Peloton, are they going to come take your Peloton? If you stop paying on your new refrigerator because you lost your job, the first loan you're going to stop paying on is something like that. Yeah, it's going to screw up your credit. But these loans that are being sold as collateralized backed loans are nothing more than disguised credit card. And because we have not lived in a world where defaults have ever reached a point where there needed to be major enforcement, because of that, I don't think people realize what it's going to be like. If the job market starts going the other way, God forbid, but cycles do say that may happen. The first thing I would stop paying if I couldn't afford was the $200 buy now, pay later loan on the beautiful toaster I bought that I shouldn't have bought last month. Now, of course, I'm just making that up. I didn't buy a toaster with a buy now, pay now, but I did buy a Peloton a few years ago with an Aspire loan just to see what this was like. 0% interest. How could I say no? Of course, I paid the loan off very quickly. And then I thought about all the other people out there in America today who have the credit to go out and rack up these buy now, pay laters, who may not have the actual financial capacity nor the integrity to make those loans good. And with the 80% of these CLOs, ABS, all this interesting stuff that was being sold, I just was looking at the chomps and scratching my head. One has to assume that there is, we've seen some canaries die in the coal mine recently. Now we're starting to see every day a new enforcement action starting to step up. And I think that's probably, if you really pulled back the curtain, you can really get a feel for what's going on in behind the scenes of these big debt funds. I think there's some concern about enforcement. And what I also want to say is that my prediction is that when the enforcement starts, you're going to see more of these tricolor situations. You're going to see more of a situation where one lender goes in to enforce on a borrower, whether it's a major corporation or some rogue investor or some California fund or some major New York hedge fund. One lender comes after them and it opens up a can of worms. And these banks and private equity groups and private lenders, everyone is intertwined. And there is a real possibility that debt markets could see some scariness in the next few months. Don't be surprised if you see more stories like Cantor Group, more stories like Tricolor, more stories like First Brands. And I have been saying for some time, I do believe a major private equity firm in this country is on the verge. Not going to tell you who it is. That's for us to find out. Thanks for joining this Debt Doctor podcast. If you like what you see or hear, please do subscribe, give a like, recommend it to friends. I'm always reachable. You know where to find me on the web. Until next time. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.